The biggest challenge that we distributors face is investors always expect returns from us, and they expect only returns, and with returns risk also comes, but risk is something that they don't want to share, they don't want to take risk. As an advisor, as a mutual fund distributor, what should we do to de-risk an investor's portfolio? To discuss on this, we have four eminent panelists, and the entire discussion is going to be moderated by my very good friend Ganesh Ramamurthy. Okay, without wasting much of time, I would want to invite Ganesh Ramamurthy and the panelists over to the stage. Over to you, Ganesh. Thank you.
A very good morning to all of you. My name is Ganesh Ramamurthy, a mutual fund distributor. I represent a firm called Plutus Financial Services. Today, we have a very interesting topic available for discussion. It is called how to de-risk a portfolio. More interesting is the curious mix of panelists that we have. We have a manufacturer, a distributor, a trainer, and a registrar. So, be rest assured you are going to get different perspectives on the topic de-risking. Before I get the insights from this eminent panel on de-risking, let me share my own thoughts. I'm going to share a real life incident, and then I will share a couple of insights that I got by reading an article. First, let me talk about the real life incident. India recently won the series against Australia. It all started in the year 2003-2004 when India toured Australia. In that series, Sachin Tendulkar, our best batsman during that time, had scores of 0, 1, 37, 0 and 44. Put together in all the 5 innings, he did not even cross 100. So when he walked out to bat during the last test in Sydney, the series was interestingly poised at 1-1. So what he did in that test was he completely eliminated playing on the offside, because in the previous 5 innings he was getting out to balls that were pitched on the offside while driving or while executing the cover drive. See, after 10 hours of monk-like discipline with concentration, he was 241 unbeaten, and India tied that series 1-1. Is there a better example of de-risking available? I don't think so. The next is the article that I talked about. This is an article by Larissa Ferrand of Morningstar, where she talks about a particular book called An Economist Walks into a Brothel. She shares a couple of insights from that book. The first one is diversification. When she talks about how to de-risk a portfolio, she says diversification is the first one. The second one is hedging. By hedging, what she meant in that article was preferring for low risk and low return products and sacrificing a bit of return and then reducing the exposure of high risk products. To me, this sums up de-risking as a whole. It's all about avoiding things that can create huge impact on the outcome, then diversification across asset classes, and then hedging. Let me now introduce the first panelist, Mr. George Heber Joseph, the CEO and CIO of ITI Asset Management Limited, a qualified chartered accountant and a cost and management accountant. He has over 2 decades of experience in equity research, and he has got wide experience in fund management and treasury management. Now, I will put forth my first question to Mr. George Heber Joseph. Mr. George, what is de-risking to you in simple terms? Please go ahead.
It's a very interesting topic. First of all, let me thank IFA Galaxy to having me here, and also the activities IFA Galaxy has been doing all through the while. Last year also I participated in IFA Galaxy, and I can say that it's an amazing activity the team is doing. And three cheers to all the teammates. And the point which you are asking, the de-risking, is a very interesting time where the markets are hitting all-time highs every day, and also Nifty touching 15,000 plus, and Sensex touching 52,000. And all these, if you see in the last 37 years, from 100 index, it has moved to 52,000 index. Looking at the entire run, I feel really marvelous. I have been associated with markets from 1991, and I can say that I've been lucky to be part of this entire journey. Watching it and playing in the markets, and so on and so forth. For a lot of learnings when I talk about the de-risking. What makes you de-risk is you understanding the risk, right? Now, the difference between risk and volatility is normally confused by people, because volatility is markets going ups and downs, right? And that can happen in any market, be it currency, equity, debt, real estate. Any markets goes through ups and downs, and that is the part and parcel of a market, right? And even if you go to a vegetable market also, you will see ups and downs in prices. But what you pick and what you choose is up to you, and that's where the risk comes, right? And as soon as somebody told that if you get out of your house, you're actually exposing to risk. And every day you are facing risk, be it in your daily life also, be it road accidents and various things you can come across. So in markets also, exactly the same thing. When you approach the market, you have to think 10 times whether your bets, what you're putting it across, is in your favor or not. For the risk can come through multiple ways. One is the valuation risk. Basically you have significant overvaluation in certain pockets of the markets. Any markets I'm talking about, you have to be aware about whether those overvaluation should I play or not. Be it in debt market, if you say, it is typically you are giving loan to a company. That's what the debt market is all about, right? When you're investing into a bond, you are giving a loan to a company. Then the first thing you have to ask yourself is whether I'm going to get the money back or not, right? And that there it starts the risk. The longer the duration, higher the risk is, because the money might not come back. And the same thing for equities. Short duration markets will be highly volatile, but long duration volatility subsides. But if you're choosing a wrong promoter, or if you're choosing extraordinary leveraged company investments, then the risk is by far the highest, because it's a bankruptcy risk is there. To avoid all these things, what you have to do is that you have to be diligent, use your common sense, apply your brains on your basic tenets of investing. See that whether you understand the business well or not, whether you understand the investments that you are making. If you're punting on currency, then you understand where the current what is the current account deficit of that country. Is that you have to ask so many questions, whys and why nots, to all your basic investing tenets what you have facing. Ultimately you arrive at a point that if I do one, two, three, these three things, I will safeguard myself. So it's all about what kind of choice that you make, and depending upon your risk appetite. And as Ganesh sir said, basically you hedge yourself from the extreme overvaluation risk. You hedge yourself from the wrong promoter, the corporate governance risks. You try to be away from leverage risks, right? And all sort of things. If you do it, then obviously your overall risk profile goes down. Now within the markets, if when I say, there is within equity debt, within equity, you have companies with large companies, mid-sized companies, and small companies. So there is a way that you can manage that risk as well, right? When you go into a large companies, the risk is much lower. But if you go into smaller companies, the risk of bankruptcy is very high, because it's not established companies. So you have to choose what bets you want to make in your portfolio, and eventually play your cards well. and that is the whole point of de-risking.
That was very interesting and insightful. In fact, you briefly touched upon my next question. See, in the mid and small cap space, liquidity is a risk that needs attention. So, how do you ensure adequate liquidity in the portfolio? Or do you perform any stress tests? If yes, can you share the insights? I would like more details on this, Mr. George.
Yeah, so in a mid and small cap, investing is very fascinating. When you do investments, you are actually buying a piece of business, right? And whenever you buy equities, you are buying a piece of business. So you have to think that whether the business is going to grow, whether the business has the conditions to grow, right? Government policies and also the underlying economics of the sector is favorable or not. And also you have to look at the management, whether it is credible management is running, and various things which you look into to arrive at the investments. Now coming to the overall investments, because the liquidity is a big driver for any markets, right? People say that today the liquidity led rally is happening. I don't understand. The any rally can happen without liquidity, right? So liquidity only drives markets. Now liquidity to come, you need to have certain scenarios to play out, or the in market participants are thinking certain things. That's the reason the liquidity is coming. They are thinking that in India is going to grow, and it is a growth market. There is immense earnings potential. It is a bottom of earnings growth in the last 20 years, and there is a significant growth prospects in the next coming years. And also the inflation globally is moving up. For so many, so on and so forth, various things you are looking into it. So, in my view, mid and small cap is a space where you have to choose the businesses well. You have to that reduces the risk significantly in terms of corporate governance risk, leverage risk. As I mentioned, if you control all these things, the nature of the portfolio itself become much more less riskier within the small cap space itself or in the mid cap space. The second thing which you have to look at is how are you diversifying within the small cap space. Are you putting all the money into one basket? Different sectors are available, like banking is 18% in a small cap index. So you have to look at, you have to benchmark to beat, how much you are deviating. Are you taking stock deviations or sectoral deviations? Within sectoral deviations, are you taking extraordinary deviations vis-a-vis the benchmark? Then you are taking extraordinary risk also. So you plan that well. That itself reduces the other parts of the risk. Third is the liquidity, right? The many companies, when you are investing in small or mid cap space, the liquidity might be very poor, and generally the capital appreciation in these stocks happens when the liquidity is very high, right? And I have experience over the last 30 years in my personal investing also. When you're buying a small cap company, maybe the difficulty to buy is very high, but at the same time, when you're selling, when the actual view plays out, the company grows size, scale, then the time you are selling, there is enough liquidity available, and that's when you plan to sell. And typically when the markets are at all-time high, and or when the stocks are going through a significant run up, that time the liquidity will be significant and you can easily sell also. So if you have patience on your side, buy into when the liquidity is very poor, or liquidity is starving. Warren Buffett also talks about it, that you invest into companies which are liquidity starving, but not business risk. Don't take business risk. Business should be good, but liquidity is starving at the point, even in the stock markets or in the company itself. Then you fuel the liquidity in the company, which is what he does in many of his investments, and then the company does very well. So the way to think about is, when you are creating a portfolio, diversify your investments into various sectors. Take stock calls boldly, but again, weightages you have to manage, because ultimately three things matters in a portfolio: the weightage, what you buy; secondly, the sectors what you buy; and also the market caps what you buy. So these are only three ways in which you can deviate and make returns or alpha for the investors. So these are the three risks which you have to control, and and the liquidity will come if the business is good and if the growth prospects are good. Eventually, the stress test is the ultimately the eating the pudding. So I believe that there is a the fun is in the eating the pudding, and I feel that there is a huge scope for the the companies in this space to look at very sensibly and allocate your portfolio to different sectors, and make sure that the risk is in a controlled fashion.
Thank you, Mr. George Heber Joseph. That was very useful. In fact, distributors have to ask these kind of questions to the relationship managers to understand how de-risking is done within a scheme. This will be very useful when they talk to the client or when they do de-risking. Now let me introduce the second panelist, Mr. Harish Rao. Harish Rao is a financial coach. He has got his own firm called Simple Equation. He has got 2 decades of experience in this industry, and he has conducted over 1,200 programs, which is a humongous number. His insights on de-risking will be very useful to the advisor community. He is an excellent writer and a cricket buff. So let us ask Harish Rao the first question, which is again very important. Mr. Harish, why is de-risking important to a distributor?
Thank you, Ganesh, and my best wishes to Team IFA Galaxy. New initiative, new ecosystem. My best wishes. You introduced me as a cricket buff, so I will have to give a cricket example, not an investment example, on why de-risking is important. See, if something is important to a client, it is important to the distributor, okay? And it is important to the client for the reasons like what Mr. George also said, and I think even what Ganesh said in his earlier introduction, that you need to diversify across asset classes, because not all of them go up and down together. Now coming back to this cricket example, Ganesh, I don't know if you remember, there was a Chennai test match in which Tendulkar hit a century in the last day against England to take us to victory. Okay, he hit some 103 runs and 196 balls in the 5th day of a Chennai pitch. Today's generation cannot play in the 5th day of a Chennai pitch. It is impossible, correct? But Tendulkar hit 103 out of 196 balls to take us to victory in that test match against England, with much better spinners in the English side. It had Graham Swan and all. But that was not the reason we won. We won because the previous evening, Virender Sehwag hit 83 runs in 65 or 66 deliveries, okay, and completely demoralized the English bowlers, okay. So he was a person who, if you ask me, he provided alpha to the chase, okay. By having Virender Sehwag, you ensured that you managed to win. Tendulkar, of course, was what in earlier days we used to call a sheet anchor. 103, he hit with 196 deliveries, played almost the entire day in the company of Yuvraj Singh, who again hit a very fast 85, and then it was like a record 387 on the 5th day in Chennai. Kohli and team could not do it a few days back, but these guys did it because you had batsmen with different skill sets. Okay, so that's the example of de-risking. Have different performing stocks, asset classes, categories, and then you will de-risk the investor's portfolio. Okay, you might not get the best return, but that's not the objective of de-risking. Okay, de-risking means you are helping the client achieve his objectives. You're helping the client to have a better experience in investing. Okay, a highly monochromatic portfolio will do best in a stock, in a bull run, correct? Not a de-risked or highly diversified portfolio, correct? You just need to have, a couple of the best, the stocks that are going on steroid, and then you would be the, best performer. But we all know that markets rotate, markets take a downturn, and the stocks, the yesterday's winners are tomorrow's or day after tomorrow's losers. So if you de-risk today, you're going to ensure that your investors have got a much better investing experience, which is really what is important for both, not only the investor but for you as a mutual fund distributor also. So I think that's why it's so important.
That was very well articulated, Harish. Mr. George spoke about de-risking on a scheme level. Now, there is something called fund manager or management risk. One way to avoid is to invest in index funds, but the sacrifice here is on the return part. An index fund will never be able to beat the market. So, what do you think, in your opinion, distributors should do? Do you think diversifying across AMCs will be a good idea? Can you share more inputs, Harish?
Most definitely, yes, you have to do it, because I think I read it long back in a Charles Ellis book. Every single fund manager is like Mr. George, bright, experienced, and all of them trying to do the best for their investors. Okay, if you've got to have 20 brilliant, committed, and well resourced fund managers, it is extremely difficult to select the best fund manager. Okay, if you have selected it, it is out of sheer luck that you have selected the best fund manager. All of them have got good investing instincts. All of them have got good research analyst teams. All of them have got good experience in the market, and all of them also want to do the best for their investors. So, and like you said, Ganesh, you should put some money even in a passive fund. An investor should definitely invest even in an index fund, some part of his portfolio. Correct? And some part of it in actively managed fund, maybe across categories that suit his risk profile best. So today you have a huge number of categories. So I would strongly suggest you invest across categories based on the investor's risk profile, based on their investors, financial objectives, time horizons, etc. You must invest across AMCs, across categories, and you will achieve more than adequate amount of diversification and risk mitigation. First of all, a mutual fund portfolio itself is a risk mitigated portfolio. By investing in one single scheme of a fund manager like Mr. George, you are going to get exposure to 60 different securities. So that's one level of risk mitigation. So, but by investing across AMCs and funds, we are eliminating the risk which you specifically highlighted, Mr. Ganesh. That is a fund manager risk, which is definitely a very eminent risk in certain portfolios.
Thank you, Harish. That was very, very insightful again. Now, let me introduce the next panelist, G. Sundararajan. G. Sundararajan is the director of Canary Capital Solutions. He has got more than 18 years of experience in the wealth management industry. His insights will definitely be very useful to the distributor community. Sundar, the first question to you. On a scheme level, the fund manager is doing a lot of de-risking measures. Then we move across AMCs by doing diversification. While we are talking about de-risking, what, in your opinion, is the expectation from the client side? That is going to be very, very useful to distributors. Can you elaborate more on this, Sundar?
Thank you, sir, and thank you, IFA Galaxy, for this opportunity, and hi to all the panelists. Very good question, sir, because what we actually do is more of risk management and not return management. So this is my personal belief, because return is actually the outcome. If the design of the portfolio is such a way that it can actually de-risk the portfolio, I think return is definitely going to fall in place. I think the most important risk when we meet clients on a day-to-day basis, what we feel is the emotional risk, because the client always get carried away, and many times there are two risks which I always see. The client does not know what he wants, or the client does not know how to express what he wants. I think these are the two important things which we need to really understand. Many times we MFD friends would have come across this question saying that whenever you ask the client what you want, the client always says, I want good returns, the risk should be zero, and I should be able to take out money always. And we all know that it is practically not possible. So it is more our duty to explain to the client, and more importantly, we need to understand what he is not saying. what he's actually not saying is that my portfolio should be broadly stable and it should give me reasonably good return. But when he always expresses saying that he wants good return. And when we say stay invested for long term, our long term and his long term are entirely different. I think this is what we need to understand and we need to bridge that gap. And whenever we offer portfolio as MFDs, I think we should always be preferred, even if the client says I will stay there for 10 years. I think some part of the portfolio should always be for a medium term, maybe a 3-year or a 5-year kind of thing, so that whenever there is a need for the client to withdraw, the client has to withdraw with the least impact or with some decent returns. Because if there is any impact on the portfolio in terms of returns, naturally the client is going to feel very bad. And more importantly, as MFDs, our job is to give a good investing experience, because the client will definitely forget that he said he will stay for 10 years and he's actually pulling out the money at the end of 30. Either blame the MFDs or the mutual fund industry as it is. So our job is to actually understand what is actually not said and actually create a portfolio in such a way that even if he has to take money in between, it has to be in such a way that the impact is least or it makes some decent return. I think that is what we need to understand. This is my take, sir.
Thank you very much, Sundar. That was very, very interesting and it was a very useful input. Listening to the silence of clients. This is going to be very, very useful to the distributors. Let me introduce the next panelist, Mr. Ravi Somasi. Ravi Somasi is the Vice President, Distributor Services at CAMS. Mr. Ravi, the first question to you, I'm not going to touch upon de-risking, it is a general question. What is your role at CAMS? This is going to help the distributor community. Can you share what exactly is your role at CAMS? Mr. Ravi.
Yeah, sure. Thank you very much, IFA Galaxy, for giving me this opportunity being a panelist here. So for the benefit of the distributors and IFA Galaxy members at large, my role at CAMS is taking care of the entire end-to-end distributor support services. It starts from the registration, ARN registration with AMFI. AMFI unit is being managed by us. And after that, empanelment with respect to AMCs and the post-registration service, post-empanelment service, and transaction upload services, as well as the customer services. This is one part of the distributor support services we take care, and the other part covers various aspects like empowering the distributor with latest products and services, self-help tools, and several mailback reports, and the host of other services and the products and facilities, and also conducting the Knowledge Connect webinars as well as the Physical Connect initiatives pan-India. Given the COVID challenge, as we have been doing through Zoom and Teams call for the last 1 year, we keep connecting with the distributors through whichever medium it is available, and this cuts across the complete all categories of distributors, be it IFA, be it a national distributor, be it a bank, or be it institutional, the complete set of distributors. So that's the role in brief.
Thanks, Ravi. I have a follow-up question. You are a chartered accountant. So in your opinion, what is de-risking to you? Please go ahead.
Yeah. So any financial professional who comes from the finance background, for them or for public at large, de-risking, yes, moving away from a bad investment or a wrong investment and keeping the capital safe. So when it comes to keeping the capital safe or risk-free or fraud-free. So if we take the last one, that is fraud-free or risk-free, keeping the account, that is the portfolio, in a very safe manner, that is having the safety consciousness right from the beginning, that is right from the setting up of the account with any AMC, with the help of the distributor, comes under the de-risking, because there are several examples, live scenarios I had seen in my 24 years and 12 years in particularly in R&D industry. The several transmissions come in, and no nomination, no proper bank details updated, and no mobile number and the other things are not registered. So I can give live examples. Not, I'm sorry. I can give some examples and then make distributors and investors more aware. And as an organization initiative, we have embarked on a large format education and awareness drives all over India.
Thanks, Mr. Ravi. Let me now move to Mr. George. Mr. George, balanced advantage as a category is a very, very interesting space. With de-risking in the back of minds, how do you think distributors can use this category to their advantage towards de-risking a client's portfolio? Please share your inputs.
Yeah, for this concept, was introduced while I was in my previous assignment, and I was fortunate to be instrumental for that product innovation under Mr. Nilesh. So Nilesh asked me that we need to find a product where investor can actually make FD plus returns, and but at the same time it should be less volatile. So from being in investments, can you create an idea, or find out an investment idea which can be utilized in some of our funds, and which we can test it out, and eventually we can scale it up. So that was a thought at which the entire the framework was set up, and I was the sole person who worked on that model, and we finally arrived at a price to book valuation framework, and then eventually we rolled it out on that product. So the product name was Wealth Optimizer, and it was a 200 crore AUM product where we started off, and eventually it took steam, and people started liking that idea that it is less volatile, but it is generating nifty kind of return also, even taking 50% of the risk of average investment horizon. If you see that the risk doesn't go beyond 50% of nifty, right? And that is what is the beauty of that product, and I'm very happy to say that it has scaled up in a big way, and it became a category by itself. So I don't want any credit for it, but I think that it's a fantastic product from the risk perspective. So when you look to pitch a equity product to an investor who is a novice investor, he has been investing all through the while in FD and fixed deposits, and as well as in traditional investment saving products, and you are bringing him to equity, he might not be able to digest the volatility, right? And in that case, a balance advantage fund can become a very interesting product to make sure that the investors the expectation is met, but at the same time the volatility is less. He doesn't need to go through the knee-jerk reaction in the markets all the time, and but at the same time it generates a decent return of 8 to 12% kind of CAGR return. If you look at the category, it has generated that kind of return. And to my mind, it is a very good tool, be it for a mutual fund distributor to use it as a good allocation product for the investor to have a smooth experience. So what is the beauty of the product is, one, it gives a smooth experience. Secondly, it's less volatile. Third, it gives you a decent return, much higher than the FD, normal FD return, which is net of tax. You don't make more than 3%, 3.5%. So this can potentially generate, history suggests that on a 10-year basis, it has generated, 8 to 12% CAGR kind of return. And if you are able to do that, the every 5 years, 6 years, you are compounding your money or doubling your money. So it is a good product to have, especially for people thinking about retirement planning, and thinking about, or even after retiring, you have a big annuity amount which you want to get. I think it is a good SWP product also. Systematic withdrawal plan also can be planned in this product. So in our case, we have launched a balance advantage fund. Only a few tweaking which we have done to the thought process. What I had earlier was, the earnings growth period like what we are seeing today. Not many balance advantage funds have tested that waters, because most of the balance advantage funds became prominent post 2010, and so you have not seen a period where the earnings growth cycle is massive, like what we have started seeing, and I believe that it will take steam as we move forward. During that phase, the fund should be relevant enough in the marketplace. Many times what happens is that, when the market is doing very well, people forget about the risk and say that, this fund is not doing the justice. So in that way, it might be worth looking at, even to make it relevant even in the current context of earnings growth scenario also, is what we have created as a model in our BAF product. So that's the only product where we are offering SWP, and we think that, it will do justice over 3 to 5 years, 10 years, to the investor fraternity.
Balanced advantage as a category is a very good de-risking role. That is what Mr. George Heber Joseph is saying. Thank you, Mr. George. Now, let me move to Harish Rao. Harish, fund selection even today revolves around past returns. Do you think setting realistic return expectations in the minds of investors will definitely help? Mr. George, during his insights, he talked about retirement income. When it comes to retirement income, more than maximizing returns or managing losses, it is the predictability of income that is very, very vital for investors. So, how do you think setting realistic return expectations will help to de-risk? Please go ahead, Harish.
In 2 minutes, it's impossible to tell you how to select a fund. So I will give that a pass, Ganesh. But yes, predicting the returns is really tough. Okay. And since the typical MFD offers everything from equity to balance advantage to hybrid to fixed income. Okay. Now just imagine if a investor has built a solid portfolio on the shorter end fixed income. Okay, he is looking at YTMs of 3 to 5%, not returns. Okay, so I mean, in such a scenario, I mean, if you have to, like what Sundararajan said, emotional management would require, it is a very tough ask. So setting realistic expectation is, not just risk management; it is your survival itself. Okay. I heard Mr. George tell about CAGR of 12 to 15%. 12 to 15%, we can only say those were the days now. Okay, where an asset class used to give 12 to 15%. Okay, now if you have to get 12 to 15%, you have to be either incredibly lucky with your entry timings and your security selection or fund selection, or you have taken inordinate amount of risk to get that 12 to 15%. A normal plain vanilla portfolio, please remember, it will have even nearly 50% fixed income, 12 to 15%, or even double digit is very tough these days. Okay, so please, the MFDs have to tell investors that the returns have to be muted. Returns, anything more than inflation post-tax, okay, and post-inflation, real rate of return itself is an achievement by itself. Post-tax, post-inflation, real wealth creation is a real good alpha generated by the MFD.
That was short and sweet, Harish. Now, let me move to Sundar. Sundar, now that we are talking about setting realistic return expectations, how do you suggest debt funds, or how do you position debt funds in a client's portfolio? Sundar, you can go ahead.
Yeah, thank you, sir. So generally, when I, especially for my set of client portfolios, I don't offer debt as a product directly. because one, debt as a product is very, very tricky, more for the MFD, also for the client, because when it comes to equity, the client is generally aware, and even the MFD is aware that there can be negative returns. But when it comes to debt, many MFDs and almost every client is unaware of that they can actually get a negative return. So generally, I use debt funds more for emergency kind of corpus, and the other debt is generally managed through the category like PAP. So that's what I generally do. Another thing, especially when it comes to credit funds, okay, that's been the talk of the town. So generally, to MFDs, what we need to do is, like as our Prime Minister keeps saying, we should be Atmanirbhar. I think we should also have Atmanirbhar research for us. Either we can use some of the tools which are already available, make some kind of effort to really understand what is behind the portfolio. And generally, the information flows, whatever comes from the AMC, we cannot take it on face value naturally, because everyone says, the general question MFD asks is the portfolio safe? That's a very subjective question, and naturally the RM will say yes, the portfolio is safe. But we also need to drill down a little more and understand what are the exposure at security level. If it is high, anything more than 3 to 5%, especially in a AA or a kind of thing, maybe that's definitely a flag which we need to keep in mind. And also at MFD level, giving a scheme-wise exposure. I think that is also very important. And tracking AUMs. I think this is one area where actually we can get a lot of insights. And these are some small steps which we need to really do and understand, and then maybe offer it to the client. Because if we don't understand and give it to the client, I think if there is, in case of any accidents, I think definitely we are going to lose the relationship and not the money of that fund alone. I think we are going to lose the relationship. I think that is where I position debt.
Good point, Sundar. Thank you. Now, let me move to Mr. Ravi Somasi of CAMS. An investment journey is not complete without timely and proper realization of funds. This is very, very essential. I believe CAMS has got lot of safety measures, lot of procedures to ensure that there is no delay at the time of realization. Ravi, can you share at least 4 or 5 important measures that CAMS has taken so that all distributors can use this to de-risk the portfolio? Please go ahead, Ravi.
Yeah, sure. So, coming to the de-risking of the portfolio, the investors or the distributors at large have to look at least 4 or 5 very important or key considerations. The first one is, at the time of setting up of the account itself, they need to ensure that the entire personal information is given completely and accurately, and as far as possible, use capital letters while filling in the application, so that the data entry and the capturing of the information will happen at the highest accuracy levels. And most importantly, updation of 3-4 critical fields, like besides the tax declarations in the podcasts and so on and so forth. The personal mobile number, the personal email ID, the nomination details, the correct address. These are the details which helps the investor to know what's happening in the account almost on a real-time basis. Any transaction happening, or any bank mandate related changes happening, or the status of the transaction which has been put through by the investor, or any other non-commercial transactions, that is account updation related events happening. All these things will be communicated as an alert to the investor. This is from setting up of the account standpoint. Post setting up of the account, continuous receipt of the information or the alerts sometimes keep bothering us, that we just skip it and then we don't pay attention. But it is very critical to have this kind of risk, de-risking or safety consciousness. We need to review each and every alert received. Nowadays, we have the transaction processing stage-wise alerts also being shared with the investors. Like, you have received your statement, your transaction at so and so time. So it has been processed, it has been endorsed. Here is the final outcome. So at every stage also, stage-wise alerts also are being shared. So we need to pay little, maybe a minute or so attention to go through those things. And in case there are any concerns or any wrong capturing or any other thing happened at the R&D end, it can be immediately informed to them. This is another thing, how to leverage the alerts mechanism which has been built by the industry over a period of time. And the third one is whether we transact or not. We have to mandatorily, that is, every investor has to mandatorily opt for a monthly RTA level cash or industry level cash. There are several, ways of getting the account statement, consolidated account statement, fund level account statement, folio level account statement, R&T level account statement, industry level account statement. So at least once in a month, investors should make it a habit mandatorily to go through this statement, to fetch these statements, go through these statements, check whether the information which has been given is in fact correct, complete, and whether the nomination, any changes are there, timely changes to the nomination, whether there is any bank account changes are there, timely changes to the bank account. We don't know when we want to redeem, and then how we will redeem. So at the time of redemption, we suddenly realize that no, not to this bank account. It has to go to this bank account because I have a commitment from that bank account. So it creates an unnecessary rush in the last moment to change the bank mandate and then the put through the redemption kind of thing. So we have to make it as a kind of habit, have this safety and de-risking consciousness throughout. So these are the 2-3 points which I would like to highlight here. And there are several other behavioral things, like whenever we are giving a cancel check, we have to mandatorily cancel it. Whenever we are giving an investment check, on the rear side, behind the check, we have to write about the scheme and the folio number and various other details, and most importantly, mobile number. Also, nowadays, banks have the habit of calling and then finding out for any check issue even before this positive confirmation came in. Some banks do that. Then, if we are giving any proof of address and proof of ID photocopies, we have to make it a habit to mention this particular proof of ID has been given to ABC Mutual Fund while investing in so and so scheme on so and so date signature, so that that cannot be used by anybody for any other purpose. So even if it falls into the hands of, say, some fraudster, they cannot utilize, they cannot leverage, they cannot use this particular proof of ID or any other document for any other purpose other than what is written on the proof and signed there. So these are all some of the good practices and safety practices which investors can follow.
Thank you, Ravi. From discussing about risk, we have moved towards safety, which is a very positive sign. Now, I'm going to ask all the panelists for a high impact statement. So this is very, very useful for distributors. What is investing without de-risking? Let me start with Mr. George. Mr. George.
Yeah, for investing without de-risking is as good as having the life without food, right? And I believe that without de-risking the portfolios, you cannot survive in the market. I give this example that if you have 100 rupees in your hand, and if you loses by 50%, you reach 50 rupees, and now from 50 rupees to get back to 100, you have to make 100%. So that is a challenge that you will face if you don't de-risk your portfolio. It is very, very important, and it's a hygiene factor for the portfolios and for even the mutual fund distributors as well as the manufacturers.
It's a hygiene factor for the portfolios. I love that statement. Mr. Harish, I'm expecting something more interesting.
Thank you, Ganesh. See, if de-risking is good for the client, it is going to be good for the MFD's business. That is extremely clear. And de-risking may not be the most, romantic thing or the most colorful thing to do. It's like, driving by respecting every single road sign you see on the road. Okay, 30 kilometers per hour, you have to go at 30 kilometers per hour. school zone, go drive slowly, you have to drive slowly. Okay. I can assure you, but you will probably be the last to reach the destination, but you will reach the destination. Okay. So that's what de-risking is. May not make for the most compelling journey, but it will be, you will reach your objective, with some safeguards in mind.
Can we say it is discipline driving us towards certainty?
Sir, I cannot use the word certainty anymore. We are in a post-COVID world now. But yes, driving us towards our objectives with a maximum chance of certainty. That's all.
Brilliant, brilliant. Mr. Sundar, what is investing without de-risking? High impact statement.
As Warren Buffett says, never lose your capital. That's rule number one, and never, meaning don't forget the rule number one. I think as MFDs, I think protecting our clients' capital is the utmost important thing, and then growing it.
Brilliant, brilliant. Mr. Ravi?
Yeah. So investing without de-risking or having de-risking consciousness is like driving a two-wheeler without a helmet on, or driving a four-wheeler without having the seat belts put on. These are available, and these have to be leveraged and followed in order to de-risk. So then the certainty aspect which you just touched upon will happen.
Now, we have moved from de-risking on a scheme level to diversifying across AMCs, and then listening to the silence of clients, and then ensuring that the safety aspects are all built in the portfolio. It has been a wonderful session with lots of insights, lots of takeaways. What I would suggest now is take at least 2-3 inputs and start building that into your practice, so that over a period of time the clients will ensure that their money is in safe hands. De-risking is a very, very interesting and a wide topic. I do understand that this cannot be covered in 45-50 minutes, but there have been very, very interesting takeaways, and I would like to thank all the panelists for the brilliant insights. Thank you once again, everyone, and let us put all the insights into practice and ensure a successful business. Thank you.
Friends, now do you know what happens when you put a group of panelists who come from a varied segment, trainer, an MFD, an RTA, and a manufacturer. When you put all these people together and the panel discussion being moderated by a very, very successful MFD, this is what you get: a rich knowledge and a complete perspective of what to do and how to go about de-risking your portfolio. I hope you all had a fantastic input. Thank you so much, panelists, and thank you so much, Ganesh Ramamurthy, for moderating this wonderful panel discussion.